It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I'm Arjun Patsati. And in this fortnight's podcast, we will discuss the impact of RBI's dictate on lenders on their bond deals. A couple of weeks back, RBI had come out with a circular saying that the risk weights for lenders lending unsecured, that is personal loans and other such unsecured loans, including credit cards, they have increased the risk rate from 100% to 125%. So basically, to a layman, what this means is that the lenders have to allocate more capital to when they lend to on an unsecured basis. And given that there's been a huge amount of growth in the personal loan segment, especially at the consumption level, this definitely has an impact on all the lenders that are showing very large growth in this particular space. And so this has taken the market a little. They become a little wary because one is that RBI clearly feels that this is going a little overboard, and hence they need to start tempering it, the kind of growth, especially on the at the unsecured level. And so in case there is some kind of a stress in the financial system, such things can be managed if it's with higher capital at the lender level. Otherwise, it can lead to a very large stress in the system as well, because the lenders will be faced to increase capital when they have no access to liquidity. That is, they don't have access to money. The second thing that is happening is that the money in the system is not very is strong. In fact, it's negative at this point of time. So there is no surplus money, and this is also leading to cost of borrowing at the short term for short end funds is going up for across the system. So NBFC is borrowing from banks, the cost is rising. Banks' cost of funds too is getting impacted because they're paying higher rates for fixed deposits and other such borrowings. So across the system, the cost of borrowings is also rising. So all put together, the lack of funds in the system and the stress on short-term rates, plus the fact that the RBI has sounded out caution and has also acted and asking lenders to increase their capital for every unsecured loan they make, then this is also causing the borrowing cost to rise. So it's impacting at two levels. The first level it's impacting is clearly in the bond market, because bond market reacts first to all such data and news. And borrowing costs, that is bond yields of lenders of all NBFCs, have risen. So many companies that actually were borrowing at lower yields a few months back are now accessing the market at higher levels of yields. This includes borrowers like Chola, that is coming out with a large public debt issue. They are paying about 20 basis points more than what they paid a few months back. Other companies include Five Star Business Finance, that is coming out with a private placement. Other such borrowers that are looking to tap the market, and all these companies, NBFCs that are coming out with bond issues, are paying higher costs. So what does it mean for the bond market and the investors? I think the reaction is pretty much good for investors, because the market has taken cognizance of this risk and is increasing the risk premium of the bonds. Investors get a better return for the kind of risk profile they are taking in, and hence it improves their risk return profile as well. And the third is obviously that the bond that the lenders, the NBFCs themselves, will be more cautious on their lendings, and then this will improve their financials and the strength of their balance sheets. So all put together, it's a pretty much a good sign for the market that bond markets have reacted in some sense. You can say negatively because bond yields have risen. When bond yields rise, bond prices go down. But more importantly, the fact that it's risen, that means it improves the risk return profile for the bond investor. So investors now can look at bond yields with a better in terms of investors can look at bonds with a better return capability, and they are pretty much aware of the kind of risk that they are taking. So these are the main increase. The sudden increase is clearly the in reaction to the both the shortage of money in the system and the fact that the RBI has come out with the circular on higher capital for unsecured loans. This should stabilize going forward, and as it stabilizes, the whole system will get used to the whole increased capital. And as that happens, then clearly the markets will then start to look at other factors, which includes the macro factors where interest rates could stabilize at higher levels, given that the US Fed has indicated that guided that there may not be any more rate hikes, and they will wait and watch for inflation data before taking any more actions. RBI too is likely to follow the same path. They'll stay status quo on rates, and also maybe soften the tone in the December policy review. But having said that, liquidity in the system has to improve, and that will come about when there is more flows into the country. In terms of the rupee is also trading at closer to record lows rather than better. So clearly there is some capital flow stress as well at this point of time. So all put together, you're going to see rates at higher levels, at least for the lenders, and but they should be stabilizing at these kind of levels before they take a fresh look in the coming months ahead. So you have a budget that is coming up, but the budget, given that it's an election year, it will just be a pass-through budget till the full budget is presented by the new government. Hence, you're not going to see too much of a impact on the markets. But then the market will still be wary of what kind of election policies that they put, manifestos, political parties put out. This in terms of subsidies and fiscal deficits and inflation and other things. So I'll put together. I think it's pretty much it's not going to be a sharp fall in yields. It's going to be more of a higher yield, higher return market, which is again good for investors. And post all the macros that are going to play out over the next 1 year, then I think markets will start to react to more of a longer term direction where they have more clarity on what's happening across. Thank you for listening in. Do follow us on all podcast channels. And if you're a financial
Attention financial advisors. Want to attract new business and customers? Offering a new asset class is the key. With debt mutual funds and MLDs losing their tax advantages, your clients need to diversify fast. Look no further than corporate bonds, the perfect solution for safety and good returns. Partner with INR Bonds for expert guidance and valuable resources to get started. Access a wide range of bonds on our portal and manage your client investments with ease. Visit partners.inrbonds.com today and unlock new business potential.